the topic is international financial market. And we're going to talk about these following international financial markets. Start with the foreign exchange markets, then international money market, international credit market, international bond market, and international stock market. If you don't feel yourself pretty much comfortable with other, if you don't understand what the bond is or what the stock market is, we're going to talk about this today, okay? Once again, I want you to relax and enjoy our conversation, right? So, these are the things we're going to discuss. So, the foreign exchange market is something to begin with. Well, it allows for the exchange of one currency for another. Okay, we know what the currencies are, right? So, we got dollars, we got yen, we got pounds, we got euros. And the foreign exchange market helps us, to exchange things whenever we need it. Well, to begin with, let's talk a little bit about the history of the foreign exchange. Well, throughout the time, there has always been the need for different nations to exchange different goods and products. That's what we call the trade, right? That's what the international trade is for. And whenever we wanted to buy, spices from India and then ship it straight to Amsterdam or some other European city, we had to have something which could be recognizable as the means of exchange, which is the money, okay? Something which could be the money for one nation would not necessarily be the money for the other nation. And that's why, through the course of history, the gold became the first means of exchange, which is the first money, okay? Because gold is pretty much hard to find. Everybody likes it. You can make some pretty nice looking things out of it, right? And, well, why not to pay different people with the gold? Okay? So, from 1876 to 1913, the exchange rate between two currencies was determined by the relative convertibility rates per ounce of gold. Which means that in 1876, there was an official agreement between different countries that, okay, if you have we didn't have the euro at that time, but if you have the pound sterling and you have the American dollars, how would you see how many dollars you need to pay for some kind of a product if the price is determined in the British pounds? Okay? For instance, we want to buy, I don't know, a sack of potatoes, all right? And a sack of potatoes at that time would cost $10. Well, that's a very huge price for that, but anyway. And if we want to buy this from the Americans for $10, we want to sell this to the British, and who have pounds, we would have to convert the American dollars to the gold. Okay, that's why we have the gold standard. And then see how much of that gold we can, we can exchange for the British pound. That's why that was a pretty good thing. And, there are some pretty big arguments and conversations and different discussions at different political levels on whether we need to go back to the gold standard in order to avoid, the inflation and other so-called, negative economic things. But this is still a matter of the discussion so far. I want you to understand that this is where it all started, the gold standard. Okay? Later, there was such a huge event which is called the Bretton Woods Agreement on the fixed exchange rates. Very often, this event is referred to as the Bretton Woods Agreements or the Bretton Woods Conference or whatever, just the Bretton Woods. Well, in 1944, you can read that from the slide, by the way, from my papers, governments would intervene to prevent exchange rates from moving more than 1% above or below their initially established levels. Well, what does this mean? This means that, people got together. See, this is 1944, which means that, remember, World War II is almost over. And after the World War II, the international money and international financial systems got a little bit, well, they changed. Why? Because the United States had most of the gold which it took from the other nations, from the allies. For example, they sold food, they sold ammunition to the Allies, which are the British and the Soviet Union. And guess what those people paid to the United States with? They paid with the gold. Okay? So, the United States got the biggest supply of gold stored somewhere on its territory. And what do they kind of, they get together and say, okay, now we got all the gold, well, you guys don't have it. So we are in the position of creating some new rules. And those rules were created right here. Okay? So far it was said that on the Bretton Woods conference, there were some exchange rates. Well, they fixed them, which means that, if you sell 1 pound of sterling in the United States, you get, let's say, $2 for it. Okay? And you cannot sell it for more or for less. All right? Well, they gave it like a little bit of margin where it could float, and they said that, like, if it's more than 1%, we got to do something about it. Right? So no more than 1% up or 1% down from the rate which was fixed by some, interstate agreements. Okay? That's what the Bretton Woods Conference stands for. Next thing in the history of foreign exchange, which gave a pretty big change, was this Smithsonian Agreement, 1971. When the dollar's value was reset, well, reset, this means that, okay, see, we got some, almost 20 years, almost 30 years passed from 1944. And since all the United States got all the gold there is in the world, and that's why the United States dollars, because those guys had most of the gold, became the most stable and maybe the most wanted currency all around the world. It created a very big demand for American dollar. This means that everybody wanted to have the American dollar, okay? Which means that the prices for the American dollar went up, right? If you want to buy something and no one has it, and you really, really need it, well, you're kind of ready to offer a little bit of bigger price. See my point? Right? The demand ups, well, the price goes up. And, but we have this old agreement saying that, no, we cannot change the price for the American dollars, for the other currencies, for the other nations, for more than 1%, which created some really bad, well, I cannot say really bad consequences, but the consequences were pretty much undesirable. If you cannot find something in the official bank, this creates a black market, right? Well, I don't know, if you got the dollars and I'm ready to pay that, like, 3 times or 5 times or 4 times more than it is officially allowed, I can just come out and say, hey, buddy, could you sell this to me? Well, why not? Maybe you need that money, okay? This is how we create the black market. And this agreement decided to reset the dollar's value. I guess they kind of reset, they made it smaller, 2 times smaller, okay? So that, they said, okay, you need the bucks, no problem. You can have it for a little bit more money, right? You can pay for it a little bit more, because everybody wanted this, so they had to take the measures. Okay, and exchange rates allowed to fluctuate by 2.25%, okay, in either direction, means up or down, from the newly set rates. So they set some other rates, and they gave it a little bit more of a fluctuation, all right? So not 1% again. But, 1971, that was a pretty big time because, nations were already trading with each other on some really big foot, and which created an even bigger demand for currency exchange. And such agreements, they just couldn't help it. Today you need the dollar, tomorrow you don't need it. So today the price goes up, tomorrow the price goes down. Okay? And maybe it doesn't go up and down by 2.25%, which we have in the Smithsonian Agreement. That's why 1973 we got this floating exchange rate system. Great, by the way, this agreement was signed in Jamaica. This is supposed to be the birth of the foreign exchange market, which we know today. Okay, it's called the floating exchange rate system, which means that today the prices for different currencies they float. Okay, you know the word float. You go up, you go down, whatever. And now this was made, like this agreement was signed because you know, people who signed it, they said, okay, now let the currencies work as the other commodities, as other products. Let them, you know, work according to the supply and demand principles. You got more money, more cash, you want to buy some dollars, you know, you go out to the market and buy it. Okay? So, this is what the foreign exchange market, this is how it looks like today. Alright? So, let's talk a little bit about how the foreign exchange is organized. This is called the spot market. Well, this is the biggest part of the foreign exchange which exists today. Well, the spot market is, like I just already mentioned, the most common type of foreign exchange transaction. And it is for immediate exchange, okay, at the so-called the spot rate. Who knows what the spot is? The spot exchange means, okay, you got it right now, you got the price for this particular time, for this particular minute, okay? This is the price. If you want to buy it, go ahead. If you don't, well, you can wait, but the price can change, okay? So, and the cost for, like, of one currency in terms of another is called the rate of exchange, okay? And this is called the spot rate. And obviously the market where these transactions occur is known as the spot market. Okay? Well, that might be a little bit complicated, but it's not. Alright? Okay, next thing. Let's discuss the spot market structure. See, like I got you a little bit more pictures, just, you know, to make you a little bit more excited about the stock market, about the spot market, about everything, all these markets we're discussing. Alright, so I want you to think about the foreign exchange market as, well, we don't have a place for it, which means a physical place, where we get together, okay, and say, all right, guys, let's go and trade some currencies. You know, that's what we're going to do today. That's why we got here all together. No, it's not like that. Well, in most cases, the spot market structure, well, it's kind of it's made of the about 20 big international banks, okay, who are, like, they have a very good history, so that's why the clients trust them. Okay, so that's why many of those transactions go through these banks. And, well, the biggest three are down here, the Deutsche Bank, the Citibank, which is located in New York, and J.P. Morgan Chase, also United States of America. And, yeah, we also have the biggest trading centers, which are not some particular physical places, but, you know, this is where the trading centers are, which means that the biggest corporations are located in these cities, London, New York, and Tokyo. That's why when we have, you know, when we have nights at London, well, people who kind of live in London, well, they're not supposed to trade any currency, they are supposed to sleep, okay? So, but what if we're not located in London? What if we are located in, I don't know, Mexico? Well, you know, if the foreign exchange would be closed in London, and if it were the only place ever where we can buy the currency or whatever, that would be a disaster. But we have New York and we got Tokyo. Well, the interesting thing is that, you know, Tokyo, this is the trading center which opens first. Why? Because the day starts from where? From the east, right? You see the point? You know what we're talking about? Okay. All right, so it opens. Well, people trade. Then the market closes. Okay. And usually, if you take a look at some specific literature or some websites, they usually, you know, put down the rate of exchange, which is called the closing rate. Like, you know, the dollar was close to euro at the rate of exchange 1.31. Which means that we can buy 1.31 euro for, well, actually we could buy 1 euro for $1.31. And according to those closing rates, the London opens, and these are the starting rates, okay? The final rates for the Tokyo would be the first rates for the London, and the same situation works for the New York, okay? Well, this is how the spot market works, okay? And all those people who are trying to sell you all that nice software, who said, you know, come on, let's trade the currency, the ForEx market. What they're trying to sell you is the software which gives you the information on those different, you know, spot rates. So you just see what's going on. And if you want to buy, you just buy. If you want to sell, you sell. And they promise you to get some, to make you enormously rich. But remember what I just told you. The biggest players for this market are 20 super international banks, okay? Which means if you have a player this big, well, that player can pretty much influence the price. Why? Because he's got in his resources, I don't know, 20 billion American dollars. And if he goes up and starts selling, then the price is going down, okay? And I don't think I would really want to be in that situation where I'm sitting there and waiting and, okay, you know, I hope the price will go up right here and then I'm going to sell and then this is going to make me, you know, extremely rich. But, I don't know, 20 seconds before that, let's say the JP Morgan Chase comes up and starts selling, then the price is never going to go up because we got so much of this currency, let's say, of the euro, that, you know, it's just going down. So, you know, I'm going to lose the money. That's why, you know, you really got to understand what we're talking about here. And don't forget that the banks might also run of some kind of currency. And, you know, maybe let's just think of a situation where, I don't know, the Deutsche Bank, they have a big client. Let's say this is the Nestle. You know this company, the Nestle? Okay, you know what I'm talking about. Right. Well, and those guys, they produce their product in euros, right? Why? Because they are located in Europe. And let's say they need to buy something from the Americans, new equipment, for example. And if you want to buy something from Americans, you got to buy this for the United States dollars. And let's say this, you know, let's say that this equipment is extremely expensive. So they go to those Deutsche Bank and say, hey guys, can you sell us some dollars for a euro? But let's say the Deutsche Bank, they have just sold all their dollars to some other corporations. I don't know, Coca-Cola or Ford Mars, whatever. And they don't have it. Okay? So what are they going to do? They're going to go to some other bank and buy that money from them. Okay? And this is going to be a very tricky thing. Well, not that tricky. We're going to talk about this right in a moment. But, you know, when we have the wholesale market, do you know what the wholesale is? Wholesale is when you come up and buy some products in very big quantities. Okay? Let's say you want to buy the computers. We have the retail for the computers, which means that you go out to the store, to the computer store, electronics store, whatever, and you buy 2, 5, 10 computers for some price. But if you want to buy, I don't know, 2,000 computers, then you are a wholesale buyer. Okay? And the price for you is going to be a little bit less. For those nice folks like me who just want one computer only. Okay? So, that's why the banks will come up and say, hey, could you sell us, I don't know, 1 billion euro? They sell this for them. We're going to talk about it because, you know, they have some things which are called the spread. We're going to talk about this. And the spread is like the interest which you're supposed to pay when you exchange, right? When you buy dollars, you usually pay a little bit more than when you sell the dollars, right? So this is called the spread. We're going to talk about this in a moment. But the general concept, you understand. So for the wholesale markets, for those banks, they have a smaller difference between the price of sale and the price of the purchase of buying. Okay? That's why we have the interbank market. The market where banks buy currency from each other. All right? This is also a pretty big part of the spot market foreign exchange. Next thing, spot market liquidity. Okay, the liquidity is the level of trading activity. What is that supposed to mean? Well, to give you the concept of liquidity, okay, who knows what liquidity is? Okay, all right, I'm going to generalize this for everybody. Let's say I have some product, or I have just something, okay? And the liquidity is the measure of how fast I can turn this thing into the money. You see my point? Okay? So, if I have, I don't know, the jeans, okay, on me, and if I want to sell it, I don't think this is a very liquid asset or liquid thing which I have. Because the jeans, some people might not like the color, some people might not like the fashion, the style. And also, you got to be of my size in order to wear it, right? So, it's not a liquid product. But, what if I have food and everybody's hungry? Let's say we were sitting here, for 5 hours talking about the foreign exchange. Everybody's sick of me, everybody's hungry, and all of a sudden, I got the food. Well, and everybody wants to buy that from me. So, this is an example of a very liquid product. Okay? Well, you see the point, right? Okay, hopefully. Okay, and the most liquid currencies would be the British pound. That's why I have this nice point here, the euro, and also to some extent the yen. Okay? The Japanese currency. Well, that's what we have. And the more willing buyers and sellers there are, the more liquid the market is. Now you understand what I'm talking about here, right? Okay, cool. All right. Now let's talk about the foreign exchange quotations. At any given point in time, the exchange rate between two currencies should be similar across the various banks that provide foreign exchange services. This means that, we're talking about a market, and a market is a pretty much complex mechanism which connects the buyers and the sellers, right? And in order to make this thing function pretty well, we got to have some rules by which we play. And the big rule is that, the exchange rates between different currencies should be the same all around the world. Why? Because, let's say the Bank of New York sells euro for, $2, and the Deutsche Bank sells for $1. Guess what you got to do? You're going to buy from the Deutsche Bank and sell to those guys in euro. All right? Make nice little 100% of the profit on the top of that transaction. Okay? That's why it's important. That's why everybody needs to have this. Okay? Same rates between different currencies. Right? Understand why that's important. All right. Now let's talk about this thing which I have just already mentioned to you. Bid and ask spread. All right. At any given point in time, a bank's bid, see in the parentheses I have the word buy, quote, for a foreign currency will be less than its ask or sell. This means that, when we take a look at the foreign exchange, well, the bid is something, it's called, let's say, the price. We don't want to say the price, we've got another word for this. Nice looking word, bid. We're the professionals. We got our own words. Right? So, the bid, quote, is like, if you want to buy, like the Bank of New York or the Deutsche Bank, they say, okay, we buy euro for 131. And they have this ask bid, which means, they ask for the euro a little bit more. Let's say 135. Okay? And this difference between it would be called the bid to ask spread. Okay? We have a nice definition for it. The bid-ask spread represents the differential between the bid and ask quotes and is intended to cover the costs involved in accommodating requests to exchange currencies. Well, I don't know. I don't have any chalk here, otherwise. Anyway, I'll try to explain that. once again, let's say you go to England and you live in New York. And let's say you have $1,000, okay? Well, guess what you're gonna do? You're gonna need to buy some of those British pounds. And let's say you got the bid rate 152, and you got the ask rate 1.6. This means that when you sell your $1,000, you're gonna get around 950 of those British pounds, or even less. Okay? Let's say that we have, because we don't have the chart, well, let's just work with some really simple numbers. All right? Let's say we sell our $1,000 at some exchange rate, and we get 950. Okay? Of those British pounds. But something happens, and you all of a sudden don't need to go to England anymore. Guess what you do? You're going to convert those British pounds back to the American dollars. And you're going to be pretty much surprised to see that you're not going to get this 1,000 back. You're going to get less. Okay? You see what I'm talking about? That's a very simple thing. And the difference between the bid and ask quotes, see, we're using some specific words for the market. Professional, you know? How does it feel? All right, so this is the difference, okay, between the sell and the buy. If you want to count, just to estimate that mathematically, you're going to do the following. You take the bigger mark, the bigger number. Which is the bigger number, the ask or the bid? The ask is the bigger, right? Okay, we take the bigger number, we subtract it, okay, subtract the minus, all right, that's the word for this, the smaller number. And then we divide the result, which is called the difference, by the bigger number, the ask. Then you're going to get the percentage, which is, well, you know, pretty much the bid to ask spread, okay? Well, don't get very much upset if I'm using some kind of words or just talking about stuff which is pretty much complicated. It's not complicated, okay? Tomorrow we will see. Right now I'm just, giving you as much information as possible. You just store it somewhere, but when you need it, guess what? It's going to pop up, right? I just want you to get a little bit more excited, people. Okay, now let's talk about something different. Next. All right, that's kind of interesting. Factors that affect the spread. What are those things which are going to make the spread, the difference between sell and buy, bigger or smaller? Okay? Right here, I have a list of those things. Well, the order costs. The order costs means how much money, as a bank, I'm going to spend if I want to place and to serve your order. Let's go with that. If it's really hard, for me, and if I need to pay 20 people who are going to go out and buy what you want, then the cost or the spread will go up, right? Okay, next thing, the inventory cost. What is that supposed to be? Okay. Remember I told you that the banks which work with the foreign exchange, they usually have some reserve. They already have some money in euro or in dollars which they can easily operate with. If you come out and buy, let's say, 100,000, you say, you need 100,000 euro, and you just sell that to that person. And then someone else comes up and says, hey, I need 120,000 of American dollars and I'm willing to pay with a euro. Guess what? You get this euro back, okay? If you kind of run out of, this balance, you go to the interbank market and you buy it from some other bank who's willing to sell. All right? So the inventory cost means the inventory is how much of that money of different currencies I need to have in my reserve. And if we're talking about the financial management, we have a very, fundamental principle which is called the opportunity cost. It's actually taken from the economics, and the opportunity cost means that, okay, if I'm going to keep this 1,000 of euro right where it is as a bank, I'm still losing some money. How is that? Maybe I could have taken this money out and invested somewhere else. Okay, and in 1 year, I'm going to make, I don't know, 120,000 a year. But I'm not doing this because I need to have those inventories to give those people who want to come and buy from me. Okay? So, this is called the opportunity cost. This costs me to keep the money in my pockets, in my safes, wherever. This is going to cost me 20,000 if we take a look at my example. Okay? Because I didn't invest it and I didn't get, you know, those 20,000 at the end. Alright? So this is called the opportunity cost. It costs me. I'm losing the opportunity. And the inventory is this amount of something which I need to have right here. I need always to keep it somewhere on my currency account. Okay? So, if the opportunity to invest in euro would be a little bit higher than the dollars, then the spread would be different. Because the banks would do what? They're going to go out and invest. Alright? So, that's why. That's why the spread would go a little bit up. Next thing, competition. Competition definitely pushes the prices down, right? If we have so many banks willing to sell some particular currency, then, and I'm one of them, guess what I'm going to do? I'm going to lower the prices to attract the customers. Okay? Just like any other. Next thing, volume. The more exchanges, the bigger sums I work with, the smaller spread would be. Why? Because let's say if I'm selling 100,000 of euro to dollars or whatever, and I'm earning, I don't know, 10%, which is going to give me 10,000, right? But guess what? If I'm going to, convert a million, I don't think I'm going to have this very same 10%. But if I'm having a lower percent, a 1%, this is going to give me that very same 10,000. Okay? So, the more money I exchange, the bigger volumes are, the more currency I'm exchanging, the smaller the spread will be. That's why the wholesale spread, for those people who want to come up to the bank and buy big amounts of money, amounts of currencies, okay, then, the spread would be smaller because this is kind of the price which you have to pay for this transaction, right? And finally, the currency risk. What if everybody wants the Russian ruble? Everybody wants it. I don't know, we buy all of a sudden Russian oil for Russian rubles, okay? And we cannot buy it for all of a sudden for American dollars. Everybody needs it. But if I am the bank who's willing to trade the Russian ruble, I need to have those inventories. Remember? Some sum of money which is, with which I'm going to operate, provide you. And, I don't know, the election. And you don't know what's going to happen next. The political instability. Well, I have a very big risk. I have a risk for the currency because if something happens, if the government comes up and says, okay, we're going to depreciate all of our money, which means they will depreciate all of their money, all of their currency, and they say, okay, we need to lower, the exchange rates or just do something with that. Well, that's definitely the risk which you are willing to take. And the bigger the risk is, the bigger the spread is, the bigger the price you got to pay for the transaction. All right? Okay. Let's go on. Next, we have those things. Direct versus indirect quotations. Remember, quotations are those numbers. All right? The exchange rates. We're just calling the quotes or the quotations. Okay, so the quotations that represent the value of a foreign currency in dollars, which means number of dollars per currency, are referred to as direct quotations. Well, mostly people use the dollars when they think about the prices of some other currency. And those are called the direct quotations, which means that in order to buy, I don't know, let's say European euro, you have to pay 1.3 American dollars. This is called the direct quotation. And if you want to know how much would the dollars be in terms of the euro, that would be the indirect quotation. Okay? So that's what it says. So quotations that represent the number of units of a foreign currency per dollar are referred to as indirect quotations. Well, those can be put down as fractions. And if you multiply those fractions, guess what you're going to come up with at the end? 1. Okay? So if you multiply the price, the direct quotation with the indirect, you're going to get 1. All right? So that's a mathematical thing, which is also not very much complicated. Cross-exchange rates. The cross-exchange rates are those rates which are between two non-dollar currencies. And it reflects the amount of one foreign currency per unit of another foreign currency. Let's say we don't want to buy dollars at all, but we want to know how much would the Mexican peso cost in terms of the Canadian dollars, okay? And we don't have the direct exchange rate for Canadian dollars and the peso, the Mexican currency, okay? Guess what we're going to do? We have those exchange rates both in dollars. And if we want to figure out, too bad that I don't have a chart for this one. Anyway, try to think of something simple. If we have the price of the Canadian dollars, let's say 0.70, which is 70 cents. 1 American dollar costs 70 cents of Canadian dollars. Okay? And we have 7 cents, which is the price of 1 peso. Okay? For, once again, American dollars. What we got to do? We got to put the smaller number on the top and the bigger number in the bottom. You divide that, and then what you're going to have? You're going to have 10 cents of Canadian dollars would be the price of 1 Mexican peso. This is called the cross-exchange rates. We kind of see where those rates, get crossed in the point where they both are traded in American dollars. And play a little bit. Okay? Well, not complicated. Maybe the words make it more complicated, but it's not. All right? You know the math, so it's not going to be a problem. Well, we have just talked about the spot market. The spot market is right now, I'm buying or I'm selling. Okay? There is another alternative, which is called the forward contracts. Forward stands for something which is going to happen in the future. All right? You need to read you the definition. The forward contracts specify the amount of a particular currency that will be purchased or sold by the MNC, remember, multinational corporation, at a specified future point in time, and at a specified exchange rate in order to hedge future payments that are expected to be made or received in foreign currency. This means that today we fix the price of some currency for, let's say, 2 months from now. Okay? I don't know. Let's say today it's spring right now. But we're thinking about, I don't know, buying something from Americans, for American dollars. Okay? And we have euro right now. So, and we're thinking about buying something from them, let's say in the winter. Well, lots of things might change, right? So what are we going to do? I'm going to sign a contract with somebody who's willing to sell me the American dollars for the euro which I have right now in winter, by the time I'm planning about buying something from Americans, for some specified, let's say for the today's rate of exchange. Okay? And we have another word which is called hedge. Hedge means to insure ourselves, just to protect ourselves from the risk. Okay? This is a nice word. Everybody's using it, so now you know what it stands for. Okay? Forward contract. We're going to buy in 2 months, in a year, at today's price. That's why it's called the forward. And maybe if I'm not going to need it, I can actually sell those forward contracts to other people. Maybe they're thinking like, okay, I'm willing to buy, well, I have the forward contract for 2 months from now, like for the price of $2, which means that, I don't know, I'm supposed to buy euro for $2 in 2 months. But someone comes up and say, hey, I'm going to pay you a little bit more for those contracts. Let's say I'm going to pay you $3 if we recalculate. Well, I'm going to make some extra profit. Because those guys are saying, hey, maybe the price is going up, and I don't want to buy for $4. So let me, pay this guy who's got those contracts for $2, and I'm going to pay some extra dollar on the top. Okay? Also, this means that those contracts could be, independently sold and traded between different individuals and different organizations. Okay? So, this is another word, forward contracts. Next thing, currency futures contracts. This looks pretty much the same as the previous, as the forward contracts. And it also specifies a standard volume of a particular currency to be exchanged on a specific settlement date. Also, something's going to be traded in the future. But, like so far, I want you to know that there are currency future contracts and the forward contracts, which stand for something like, this is an agreement that I'm going to buy something in the future for today's price. These are called with the different words because we have different regulations. And you see, we have standard volumes. If for the forward contract I can buy, 15,000 euros in a week, then I cannot buy 15,000 euros in a week with the currency future contracts because the minimum currency future contracts could be 10,000 euros. Okay? So, this is called the standard volume. Alright? And I put down this small thing. That it's similar to forward contracts, except that they are sold on an exchange, whereas forward contracts are offered by commercial banks. This is another difference. Okay? So, the forward contracts are offered by commercial banks. These are on the exchange. Okay? Which means they are more freely circulated because we have standardized volumes of those, okay? So I think, okay, I'm going to buy, 20,000 of Japanese yen in 3 months. Well, I go out on the market. Remember, 20,000 means 2 standardized volumes, okay? So I'm going to buy 2 currency future contracts. Okay? That's a little bit. That's the difference, the basic difference. All right? Next thing. Currency options contracts. Hey, what the heck is that? We already talked about the forwards, the futures, and now we're going to talk about the options. Come on. Also, this is not that complicated. Options. Let me read this definition for you, and we're going to discuss it. Okay? So, we got 2 types of options. First called is the currency call option, and others called the currency put option. After I'm going to explain that, it's not going to be anyhow complicated, okay? So, but first I'm going to read you the definition. A currency call option provides the right to buy a specific currency at a specific price, which is called the strike price or the exercise price, within a specific period of time, used to hedge future payables. We're going to talk about those future payables. And the currency put option provides the right to sell a specific currency at a specific price within a specific period of time, used to hedge future receivables. Well, option, it's an option. Option is like a selection, a possibility, okay? And it works a little bit different. When we were talking about the futures and the forwards, I was obliged to buy that, okay? Because I signed the contract, and within the options, those contracts work a little bit different. This is an agreement between me and the seller or buyer. It depends on what type of option we have, the call option or the put option, which gives me a right to buy something for the today's or for some other price. But if I'm not going to do this, I can still refuse and pay a small premium. Okay, small fee to the seller or the buyer. I'm going to give you an example. Well, let's say I'm thinking about, I want to buy 10,000 American dollars for 9,000 euro in 2 months. Okay? Well, and I sign up that if I'm going to buy, I hope that the price is not going up. Right? This is what I'm doing. This is what I'm doing. And this is why it's called the hedge future tables. I can hedge. I can, protect myself from the risks when I need to pay for something. That's why I need to buy this, because I'm thinking about paying some other guy. All right? In American dollars or in euro or whatever. Remember this example. 10,000 of American dollars could be purchased in 2 months for 9,000 euro. But let's say the price goes down. And, in a month, I think that, hey, the price is much better right now, and right now I can buy one at 10,000 American dollars for only 7,000 euro, which is less. Okay? Definitely, I'm going to buy that. But I still have this currency option contract. I'm going to say, okay, I'm going to call this other party and say, okay, I'm not going to buy that in 2 months for 9,000. I'm buying it right now for 7,000 because the price is obviously much better. But I'm going to pay him some premium. Let's say I'm going to pay him 500 euro. Okay? Because, I didn't exercise the contract, but I can still refuse it. It's not the fine, it's just the premium for the other party. And at the end, I'm buying 10,000 of American dollars for 7,000 euro plus 500 of this premium because I didn't exercise. That's why we have the exercise price. Because I didn't do what I was supposed to, okay, on the currency option. Do you see my point? Okay? Yeah, hopefully we have some charge. Anyway, I don't want to waste the time. And that's why we have do not require any obligation. Well, we have options for different things. We got the stock options. We got the real estate options. For example, if I'm thinking about, like, maybe I want to buy another trading center, construct another trading center right next there, okay? In 2 years, for example. And I think that the price is going to go up or down. Maybe I'm going to sign an option contract for the future purchase of a small land plot. Okay, land on which I'm going to build my new trading center. Okay? Also, I can sign this type of agreement. And if you want to remember the difference between those two, here's an easy thing. Why we call it the call option and put option? Because when we say call, we mean call up. This means that I'm buying right now because I think that the price will go up. You see my point? I can buy anything else, I don't know, the stock or something else. Price goes up, I'm buying right here at the price which was down here, okay? And selling right away and making a profit. And the other way around is that the put option, which is put down. Okay? Maybe I'm thinking, hey, if I'm not going to sell it right now for this price, there's no way I'm going to sell it for this good price in the future. So I'm going to find someone who believes the other way around, who thinks that, prices will go up. And we sign this thing. This is actually, this conflict between our ideas. I think that something goes up, I'm going to, buy the call option. Or I believe something goes down. I'm buying this put. Okay, call up, put down. Hey, thank you very much. They say that the chalk is a very good source of calcium for your body. Does anybody want to try that? No? Everybody can? Okay. All right. Yeah, since we got a chalk, thank you very much. I'm going to give you this. All right? Today's price goes up. Call up and put down, okay? Let's say we have the euro USD. We need to buy that. And we're going to pay 0.71 euro for $1 American. Remember, this is an indirect quote, right? Because this is the price of the United States dollars in euro. Okay? All right, and if I believe that the price would go right up, and I'll have to pay something like this, okay, for $1 American, well, I want to fix this price for today. Or, I think that it's going to go even down, I don't know, 6, then I'm willing to say, to sell for this price. Okay? Is it bad when you see this? Okay. You gotta be grateful for this guy. That's the one who brought the chop. Okay. Finally. Let's talk about the international money market. All right, we're done with the foreign exchange, the money market. Well, there are different classifications of financial markets, and we have this classification. Today, we're going to talk about like more specific things. Like we have the money market. And the money market is it's the market where the corporations and governments, they borrow in foreign currencies. And, also the people who borrow and the people who invest in foreign currencies. But it's important to see the difference that it's the short-term investments. Short-term means like, if you take out a loan, you know what the loan is? Okay. Well, it's when I borrow money from you. Okay? Let's say, okay, I'm going to take $10,000 from you and pay you with interest on it. And I don't know, in 2 months, you're going to have $12,000, which is bigger. Okay? 20% interest for 2 months. Wow. Okay. The money market, short term, up to, 13 months. Which means you borrow or invest for a short-term period. Okay? That's why we call it the money market. We call it the money market because it's very liquid. Remember the liquid. We can exchange something fast. And the most liquid thing which you can have in your company is the money. Right? Everybody wants the money. Nobody wants your computers, for example. The computers would be harder to sell. That's why we call it the money market, because things are very fast. All right? So, and yeah, we can read this. The preferences of corporations and governments to borrow in foreign currencies and of investors to make short-term investments in foreign currencies resulted in the creation of the international money market, which is kind of a, some of I have just explained. All right? And there are other things which I want to discuss. Well, the money markets, all the other markets I'm going to talk about, they refer to the interest rates. Okay? The interest rate is the, let's say the rate, usually in the percentile, of the interest on some loan. For example, if the interest rate in the United Kingdom, which is the Great Britain pounds, let's say 7%. This means you can take the money, take the loan, borrow from somebody, but you have to pay the 7% annual interest rate. Okay? They usually calculate it on an annual basis with market bill of credit. And let's say you have the, Germany, which has those euros. And let's say they got only 3%. If I want to borrow the money, this is where I'm going to go, right? If I want to invest the money, I'm looking for a bigger rate. This is where I'm going to go. Okay? But remember that whenever we're talking about this, capital markets, well, we're gonna, I don't want to confuse you with the terminology, but anyway. If we're talking about investing and borrowing, we need also to remember, when we discuss the international market, you will always have the risk of the exchange, right? Because you need to see what would be 1 Great Britain pound, if you exchange that through the euro. Or maybe something's going to happen. Maybe the risk is that big that, that's why the people have it. They got to have some points for this, right? So, also you're going to face some kind of risks, which is the, exchange risk. But, international money market. And what influences those different rates? Well, if we have some savings, well, until recently, Japan had the lowest interest rates. If we have the savings, we don't need to borrow the money, right? If you want to buy a car for $10,000 and you got that money saved, guess what? You're not going to need to go to the bank and take out a 10,000 American dollars bank loan to buy yourself a car, okay? So, guess what? The banks, they don't want to get, just find themselves without any work. So they're going to lower that just to attract you. They're thinking, well, okay, I'm making pretty big, I have a nice salary. Well, maybe I can still go and borrow for 1% or 2%, which is not much. But I'm definitely not going to borrow this at 7%. Because, I got some savings. I got some money under my mattress, all right? Okay, but what if the people don't have the savings and they still want to buy the car? Guess what? This is going to go up. All right? But still, you must remember about those different risks. And this is what, kind of influences those things, the rates. Next thing. Okay. We got, that's what we just discussed of that. We can read it fast. Money market interest rates and non-currencies. If there is a large supply of savings relative to the demand for short-term funds, the interest rate for that country will be relatively low. Remember, Japan. If there is a strong demand to borrow any currency and a low supply of savings in that currency, the interest rates will be relatively high. Think of Ukraine, think of Russia. We have much bigger interest rates. If you want to go out, take out the bank loan to buy yourself a car, right? Think of it. All right, we just discussed that. This is just more. Next thing. International credit markets provide access to medium-term funds through term loans from financial institutions or through the issuance of notes, which are called the medium-term debt obligations, through banks located in foreign markets. These are, this is called the credit market. Same idea as with the market loan. All right, but it's, it depends on different countries, but it's bigger than 13%, than 13 months. Maybe 13 months, but up to, it depends, up to usually 3 to 5 years. Okay? That's called the credit market. Not the money, because, it doesn't have this liquidity of the money, right? Because it doesn't turn this or that. Okay. See, we got the credit card now. Next thing. Now we're going to talk about the international bond market. And we were talking about these things. Some, people, some specialists usually combine this into the credit market, both of these, and call it short-term and long-term credit market, okay? Some just don't differentiate, they don't call it the money market and the credit market, they just call it credit market, short-term and long-term. And now we're going to talk about the capital market, okay? And the first thing about that, international bond market. Do you guys know what the bonds are? Okay. Do you know that? Okay. The bonds is an obligation which I, as a company, create in order to borrow money from. I don't know. Let's say the banks are going to charge me this 7% right now, but I don't want to borrow the money at 7% from the banks. I'm going to take a seat and say, hey, maybe there are some people who would like to, give me the money for 5%. Okay? But at the longer period, for example. Okay? Let's say have you seen this nice sign? This is called the at, and is usually used to denote different periods or prices. Okay? 5% at, for the period of 10 years. And I'm going to create those bonds, those contracts, which for example, if I'm selling this bond, they also have the same price for that, to somebody, and I say, okay, I'm ready to pay those 5%. Okay? And you think maybe in 2 years, yeah, I want to have a bigger percentage, bigger rate, and you can sell this to someone else. But me, as a company, as the issuer of the bond, I will still have to pay that because I borrowed. Okay? Those are called the bonds. Not only the corporations create the bonds, but also the governments create the bonds. Okay? And these are usually for the longer period. And that's why we call it the capital market. Because you're thinking about, saving your capital. Not just play with the money, not just take it here, invest it there, and on a short period, get some profit, for example. We call it the capital market because we're thinking about, holding those bonds for 20 years, 30 years, okay? So those are called the bonds. So, international bond markets. The MNCs may choose to issue bonds in the international bond markets for 3 reasons. Reason number 1. To attract a stronger demand by issuing bonds in a particular foreign country rather than in the home country. Do you understand what's here? Yeah, if I'm going to issue the bonds, which would offer 5% annual interest to the Germany, to the Deutsche market, then, if they have only 3%, of course they're going to buy this because this is bigger than that, right? So, that's why we do this on international scale. That was the reason number 1. Next. To obtain funds in currency where the currency for a new project is widely used. Let's say we're thinking about starting some new, venture, some new idea. We're thinking about opening, we ordered Coca-Cola. We're thinking about opening a new plant, a new factory for Coca-Cola products production. And we want to sell it to the people. In Germany, once again, we know that we're going to sell this for the euro, right? Because this is where we're going to sell it. We're going to sell it in Germany. People got the euro in their pocket. Okay? That's why we want to take out, we want to borrow money in the same currency with which we're going to pay this money back. Because there is always a risk, that the prices of different currencies are going to change. Okay? So, and that's why people also offer those bonds. And willing to take the money in the same currency with which they expect to have their revenues. Okay? They're going to get the euro, they're going to give the euro back. They don't want to take the American dollars because then you need to convert that, and this might, be a kind of a risk for you. Alright? If the price is going to change. And the prices will change. Okay. Hey, not here yet. The final one. To reduce the cost of financing using a foreign currency with a lower interest rate. Well, same idea. You want to borrow from the people who are, in Germany at 5% because, you're going to convert it and, I don't know, do something where you have those 7%. All right? So this is definitely going to cost you less because people think, hey, 3% is already fine. When you take it for 5, well, just want to avoid this difference. Okay? So people are willing. Even you don't even need to, offer for 5%. You can offer this for 3.1%, and everyone will gladly come. See, this is also another reason to just want to avoid it. That's why I really like the financial management. You think about, risks and how to avoid things happening, and if you're smart enough, well, it's going to be a big package. All right, we're done with the bond market, the international bond market. Now let's talk about the international stock markets. Who knows what the stock is? Okay, I'm going to explain to you guys. Stock is the share of ownership. Okay? All right, that's the stock. For example, I'm starting a new company, but I don't have money. Let's say I need 5 million. And I'm thinking about maybe I need to go out and buy American and borrow this 5 million from the banks. But the banks say, okay, we can give you this 5 million, but you will have to pay us, 4% annually. But if you take a look at this, I'm only starting my business, and I'm not expecting to have any profits in 2 or 3 years because I don't have those factories to sell, ties or computers or whatever I'm thinking to sell. Okay? So, guess what I'm going to do? I'm going to think about, well, what if I want to attract some investors and say, okay guys, I'm not paying you those 4%. And they say, okay, why do we need to give you the money then? But I'm saying, guys, you want to be the partners with me. Why not? And I'm going to make 1 million of shares, which will be traded at $5 each. And you will be the co-owners of my company. Okay? Well, the stock market is different because if we are the co-owners, we don't need to pay anybody because we own the business. Now you're my partner, okay? If we're gonna make, 30%, profits by the end of 3 years, we're gonna share this according to the number of shares, okay? If we make, 15 million in profits, then all of those people who had 1 share, right, and paid $5 for it, you're gonna receive $15 for each, which is pretty much fantastic. Okay? But you are the owners now. And this is why we call it the shares. And we sell different shares on the stock market. Okay? And the stock market usually, it is represented by 2 major figures. There are some people who believe that the price will go up, and most of them, and it's called the bullish market. Okay? And there are still some people who are pretty much skeptical and think that the price will go down. Those are called the bears market. That's why I have those 2 nice little things here. Okay? So, now let me read you the definition. International stock markets. MNCs and domestic firms commonly obtain long-term funding by issuing stock locally, meaning in the country where they are located. Yet, MNCs can also attract funds from foreign investors by issuing stock in international markets. Well, why could be that? Well, maybe I want to, establish my reputation of an international company, okay? And I want the support from the locals. And if the locals own some part of my company, then they're definitely going to buy the products. Okay? Something like that. And maybe I can offer a bigger price here, Once again, because those rates are small, and people think, hey, maybe this looks pretty much possible in the future, and we're going to get only 3% for our money. Now, this guy offers 30% in 3 years. Well, who knows what's going to happen in the future, but still, I'm going to buy those shares. Okay? So, this is called the stock market. Also, the part of the capital market. See? We're taking this and holding this for long. We don't want to sell it that fast. We're not going to make it, fast profit, as if in the credit market. Okay. And why do people invest in ForEx markets? Now let's take a look at this idea from the point of view of the investors. We understand how it works in terms of company, and let's talk about the investor. So many investors purchase stocks outside of the home country because the investors, first, may expect that economic conditions will be very favorable in a particular country and invest in stocks of the firms in that country. For example, we think that, Japan. We think that Japan will have a very favorable condition, some very favorable condition. For example, the government is thinking about lowering the taxes for the new countries, which will make everybody start their business. And if everybody starts the business, maybe they're going to grow faster. And maybe they're going to give you, I don't know, even 36% return, which is way, okay? So that's why sitting there in America and having American dollars, I'm going to go do what? Go buy the Japanese yen and buy some shares of new companies from Japan. Because I think that, the Japanese will do something for their country which will, propel, some industry or maybe the entire economy of the country. Okay? Next reason. The investors may consider investing in stocks denominated in currencies that they expect will strengthen over time, since that would enhance the return on their investment. That's another trick. See, you gotta know math for this pretty well. Well, let's say you buy stock for €5 now, and you're thinking about selling this stock for those very €5 in 1 year. Okay? But you bought this for American dollars. And after you sell it, you're thinking about converting this to American dollars again. If the exchange rate, if the euro would appreciate, go up, okay, relatively to the dollar, then after you sell it, maybe you just have to pay $6. After you sell it, you're going to have $10. Not bad. Okay? Another trick, also math. That's simple. And finally, invest in stocks of other countries as a means of diversifying their portfolio. Well, there are some big institutions which were created in order to save the money of the bigger group. For example, pension funds. Well, the pension funds in different countries are pretty much different, but let's think about, I don't know, in America they have the private pension funds. They say, okay, you guys invest while you work. After you become of the age of 60, for example, we're going to pay you that interest which we earned. And those guys, they take your money and invest in different shares and different bonds, different stock and different bonds, creating the big, let's just call it portfolio of those different things. Well, and there are different techniques of how to manage the portfolios, and this is called the corporate management, But also there are different risks. Some countries just have big fluctuations. I don't know, their stock goes up and down. Or some countries have wars, whatever's going to happen. Okay? So, I'm thinking about hedging, remember, protecting myself from risk. And that's why I'm going to buy some extra shares, some extra stock from another country who doesn't pay bigger interest, but which doesn't fluctuate that fast. Because I want my portfolio made of this, steadily grow. Okay? Or at least not go down. Alright? And this is what is called diversification of risk. I just place this risk in different things so that, they kind of, this is more of a statistics and other math, so we're not going to go into that much. Hopefully you got some pretty basic idea. Okay? So, those are the markets I wanted to discuss with you, and now I want you to take a look at this small example. Well, this is an example of how, the money can be circulated using different financial markets, international financial markets by company. See on the top we got the M&C parent, which is the big company, okay? Multinational corporation, which let's say created some different departments. One of these is called foreign subsidiaries right here, see? On the left corner, the bottom. And you see how different things, how different markets, international markets are involved in. Well, for example, the foreign business clients, we need to import and export, which is buy and sell, right? And we always need the foreign exchange market, which is on the top. See, this line always involves the foreign exchange. That's why there are so many fluctuations, okay? Because different companies need different amounts of that. And that's why, different people promise you, okay, you play, that's why they call it play, you gamble on the foreign exchange and you get some scrapes and make yourself rich. Yeah, probably. Anyway, also you can have the earnings, remittance, and finance. Well, from the foreign subsidiaries, you're going to have, people are going to buy your products in the local currency. And you also need to exchange this in order to take it back to the country from where your company is from, the M&C company, okay? International money market, short-term investing in financing. You take it, you also need to exchange it, see, on the top. Next, international credit markets, medium and long-term financing. Same thing, you borrow the money, also need to convert it. International stock market, long-term financing. Well, same idea. You're going to sell your stock, attract the investors from different countries, and still, you need to, exchange that money. That's why foreign exchange market works really fast. Okay? Just take a look at this. This is a general idea of how things might work for a typical multinational corporation. Okay? That's why it's called for a cash flow chart of an M&C. All right? And finally, thank you for your attention.